Waterlife has just launched its Big Picture campaign. What's this about and what are the key messages?
Okay, so the Big Picture campaign is about an education piece for brokers working in the equity release market around the need to step back with clients and see a bigger picture when it comes to their full circumstances, specifically their health. Waterlife specialises in enhanced equity release. So these are loans for people with medical conditions or lifestyle issues that may shorten their life expectancy. So just as in the enhanced annuity market, you can get a bigger income. If you've got medical impairments, we will offer a bigger loan to clients if they've got certain medical conditions. The problem that we find is that very often clients are not offered an enhanced equity release solution. How do we know that? Well, we've done some research and we believe that as many as 75% of people aged 65 and above could qualify for some form of enhancement. So that could be anything from being type 2 diabetic or being on tablets for high blood pressure, through to people who've had a heart attack or had cancer. So 75%. But last year, looking at the new business statistics from the Equity Release Council, we think only roughly 1 in 6 people who were sold an equity release plan ended up with an enhanced plan. So there's a big gap between those who can get it and those who do. Now there may be several good reasons for why people don't end up with an enhanced equity release plan. They might actively decline it. They might say, no, I want a cheaper interest rate, or I want a lower loan, I don't need a big loan. Or they may refuse to disclose health questions, and that's a separate issue in and of itself, actually, a consumer education piece. But we think some of the issue is that for whatever reason, brokers are not asking their clients those health questions. So the Big Picture campaign is about an education piece for brokers to say, ask the health questions, even if ultimately an enhanced equity release is not the solution for your client, because it won't be right for everyone. But even if it's not, ask the health questions first, get a full picture of your client, and then you can make it part of your recommendations. Whether or not your client takes it up is up to them, but at least you've covered that set of circumstances.
So asking health questions can get clients a bigger loan. Does that mean they just end up with a bigger debt?
I think that's a popular misconception with enhanced equity release. It is true that traditionally and predominantly enhanced plans are used for max cash, what we call max cash solutions. So people who are looking for the biggest possible loan to take out of their house. And so Waterlife, for example, offers loan to values of up to 55.5%, which is the highest in the market. But it isn't always about getting max cash. So as an example, somebody might want to take a smaller loan up front, and they might at that point in their lives think, that's all I want, I don't want any more. But retirement can be 20 or 30 years these days. Very often is at least 20 years. So client circumstances can change, and so what will happen often is people will come back 5 years later or 10 years later and say, actually I need some more cash now. So getting a bigger loan to value at the beginning means that you have a bigger facility to draw on. So let's say you get a loan to value that will give you a loan of £50,000, but you only need 10 today or 20. That means you've got another 30 or 40,000 pounds that you can draw on later on. So getting a bigger facility gives clients more flexibility in the future, but it also means that they can protect a bigger element of their estate for inheritance, and that's another factor that we find clients are often very concerned about, passing on equity to beneficiaries. And they worry about that if they take an equity release loan, that there'll be nothing left for the children once the house is sold and the debt is repaid. So by getting a bigger loan to value and a bigger facility up front, they can actually protect an element of their equity for future beneficiaries through something we call a guaranteed inheritance feature. So max cash is definitely one reason why you do enhanced equity release, but there are many other reasons why somebody should at least be offered that possibility as well.
Are there similarities here with the enhanced annuity market? What are the prospects for the enhanced equity release market?
I think there are. I think there are things that we could learn from the enhanced annuity market. Enhanced annuities are have been around a lot longer than enhanced equity release. So the first enhanced or impaired rates on enhanced annuities appeared in the early 90s with smoker rates and rates for people with cancer. Enhanced equity release has only really been around in the last 3 or 4 years or so. In fact, More to Life was one of the first companies to pioneer that. So we're a long way behind enhanced annuities. As I mentioned earlier, we think only roughly 1 in every 6 plans sold today is on an enhanced basis. So we think it should be many more than 1 in 6. So we've got a long way to catch up. But I also see parallels here, or potential parallels here, with the way that the enhanced annuity market has gone in terms of educating brokers and getting them to routinely ask their clients questions. And that happens more today than it used to do, but it still doesn't happen as often as it should, because the FCA they've launched an inquiry into this recently, a thematic review of enhanced annuities, because they're worried that some clients who could have been sold an enhanced rate have actually been sold a healthy plan instead. And so we are concerned that that might be something in the future. The FCA looks at the equity release market and says, well, could some clients have been offered or sold an enhanced equity release when in fact they were sold a healthy one? So we're not at that point yet. I think there's a long way to go. We're part of that education process, and I think we've got an opportunity to learn about how the enhanced market went about revolutionising that space and doing the same in the enhanced equity release market.
According to the Equity Release Council, 2015 is gearing up to be a record year. Are you seeing similar growth at More to Life?
Yeah, so the Equity Release Council are absolutely right. They've published figures that show that the sales in the first half of this year were a record. Last year was a record for the equity release market, 1.4 billion of sales. At the end of last year, there were lots of pundits saying that 2015 could be 2 billion, and I think we'll be somewhere close to that, somewhere around about the 2 billion mark. So it will be another great year. So the year-on-year growth is looking very, very healthy indeed. And that's been reflected within More to Life. It's been a fantastically busy year for us. Lots of brokers engaging with us. We're engaging with more brokers than ever before. More and more brokers are registering with More to Life, are doing business with More to Life. We've been very busy enhancing our product set as well. So we've improved our loan-to-value rates. We've improved customer incentives like cashbacks as well. We're just about to launch a new plan aimed at people who don't qualify for enhanced, so people who are healthy and don't get an enhanced rate. So it's been a really fantastically busy year for More to Life, and it's looking as though that's just going to continue on. So we're really excited about the future of this market at the moment.
What is More to Life's view of the future of this market, and what are the challenges that you see ahead?
Well, I think the future of the equity release market is very rosy indeed. There are a number of what I would describe as growth drivers for this market. There's going to be ongoing organic growth. The baby boomer generation is still coming through to retirement. People are getting older, the population is getting older, so more and more people are entering that age group that start to look at equity release. So that in itself will just drive growth in the equity release market. But there are other key growth drivers as well. One of the biggest, I think, over the next few years is what's often referred to in the press as the interest-only time bomb. So thousands and thousands of interest-only mortgages are coming through to maturity over the next 15 years, where the people who own those mortgages are over 65 and they've got no way of repaying the debt, or certainly not repaying all of it. So they're going to need a solution, and equity release is one of those solutions for repaying that debt. So that's going to be a huge driver, because there are literally billions of pounds of interest-only mortgages which have to be repaid one way or the other. Some people will downsize, but that's not for everyone, so that debt has to be repaid. And of course the other, I think, slightly unknown factor at the moment is how pension reforms will ultimately influence equity release sales, because more and more people now, with the new freedoms, they're cashing in pensions, they're looking at pension planning in a different way. And we did some research earlier this year, and we asked consumers about whether they felt now that their home was part of their pension assets. I don't think that's a way of thinking that clients have generally had in the past. A home is something you pass on to the children when you die, not necessarily something you regard as something you use for your pension planning. But we found that more than half of the people we spoke to said yes, they do regard now the home as being part of their retirement assets. So people are starting to look at the family home as a way of generating an income in retirement. the average home in the UK is worth, what, 8 to 10 times the average pension pot. So if your pension pot is not going to last for the rest of your retirement, you're sitting in a house which is worth maybe 10 times that. It's not a huge leap of the imagination to see why people are starting to look at equity release in a different way. It used to be regarded as an end-of-life product, a distressed purchase product when you were desperate for cash. I think today it's becoming more part and parcel of retirement planning. People are looking at the house thinking, well, it makes more sense to eat my bricks rather than eat through my pension. So I think the market will continue to grow. I think those growth drivers will see that potential grow even further. So I think the next 3 to 5 years can be really exciting in the equity release space, actually.
Great. Thank you very much for your time.
Pleasure.